Good morning, Patrick, and welcome.
Good morning, Gloria, and to everyone else.
Okay. We do have apologies from Mr. Chengelo Mape, who's unable to join us at this time. So let's just dive right into it. So what was your initial reaction when the budget was presented, and what do you make of it?
Thank you so much, Gloria. Just want to confirm if I'm audible.
Yes, you are.
All right. I think the themes of the budget were quite clear. A lot of commentary have come out around how expansionary it was. By expansionary, we mean government expenditure is quite up. The key themes are around decentralization and taking expenditure to the constituencies have been talked about, changes in the mining tax law, and targets to also try and boost that sector. So I think initial views were it was quite different from what we've seen in the past, quite expansionary, and a lot of changes. And I think it's one that has, of course, brought a lot of commentary in the market, and that's a good thing as it continues to be debated.
Okay, and Patrick, what's your view of the budget?
Yeah, I think the sentiments are quite the same as Mumba. Am I audible as well?
Yes, you are.
Awesome. Yeah. I think the fact that it's a fairly expansionary budget means that it bodes fairly well for the built environment industry, as well as real estate, considering the fact that there is a lot of spending that has been allocated to different industries. There's a perception, or at least an intention, that some of that spend will be felt within the real estate industry. So it's very timely as well, seeing that the whole globe is coming out of call it 2 years of stalemate or very little business that was taking place. So any form of capital injection or spending that is taking place here forth is very much welcomed by the industry.
Okay. Coming from a background of contraction in GDP in 2020 and also seeing inflation reach as high as 24%, the government wishes to turn things around, and in order to attain a real GDP growth of at least 3.5% in 2022, as well as reduce the inflation to single digits by the end of 2022. How feasible do you think this is? Mumba?
The inflation one, the inner economist in me tells me when you have expansionary fiscal policy, that tends to be inflationary. So if government is trying to reduce inflation and yet boosting expenditure, it makes you wonder if the two goals are aligned. But I think interest rate policy will be key. Typically, when you do see governments try to aggressively curtail inflation, there's some form of interest rate hikes to try and reduce that. Looking at what Bank of Zambia have been stating, they have kept policy rates. They did increase the policy rate once, I think in the last year, but subsequently they have been keeping policy rates stable. It looks like if we do see rising inflation once again, I think that would be key. So I think question number one is we need to see what Bank of Zambia does. Anything to control inflation might require reducing or increasing policy rates. There are also other factors that government might not have so much control over. The oil price, government has no control over that. And so if we see oil price really spiking in the globe and the supply-demand dynamics really shift, it'll be very difficult for government to control rising inflation. And so I think in as much as we've seen the goals of Ministry of Finance in managing inflation, it's important to see what Bank of Zambia does because the two have to be aligned, and also what global factors could still affect Zambia could also result in government finding challenges in managing that inflation. So I think in summary, it's one that we will need to watch more clearly as with everything in the budget, it's all about implementation, and it's not quite clear as of now how that goal will be achieved without knowing what Bank of Zambia will be doing.
And maybe just to add on to that, and what we're also seeing here in South Africa, where the budget is very, inflation managed orientated. The price of electricity and electricity tariff hikes is certainly something that may cause a challenge when it comes to keeping the economy within the inflation target. If you look at what has happened to coal price globally, having more than, I think the latest figures is that it has gone up by over 80%, if I'm not mistaken, the last couple of weeks. And what that does to your overall cost of electricity, and how then that translates to manufacturing costs, which are eventually then borne by the consumers. So depending on how electricity tariffs are managed, I think that will be a main challenge to keeping the inflation within the target.
Okay, and then in terms of growing the economy, I think there have also been some changes to the mining tax regime, and we've seen the commodity prices of the copper prices on the London Stock Exchange being somewhere around $9,000 per ton. And the government is intentional in trying to grow the mining, to grow the output from mining from about 1.8 million tons to over 3 million tons in the next 10 years. Do you also see that as contributing to the other sectors like agriculture and manufacturing in terms of growing the mining sector as well?
Of course, I think anything that boosts mining activity and productivity is good for the country. It's still the biggest driver of GDP growth. And so if the copper prices are sustained, you can see new investments coming into the mines, that will be very good for the local communities in terms of economic activities and jobs, as well as for the economy at large. I'm sure for the property sector, I think there are examples in Zambia, like Kalumbila town, which were really born out of mining activity in the northwestern province. And so if there are big finds of that nature, although I think when it comes to the mining sector, there's also the issue of the time lag, in as much as government can change the policies and make it more advantageous for new investments. Setting up a mine, building a mine takes time. And I think a lot of the mining companies would also want to be sure that this tax policy will be taken up for the long term. So I think it's also still a long-term play in terms of mining activity. It takes quite a long time to develop a mine and set it up. And so we may not see the immediate effects in the short term, but surely the policies do encourage for investments, and we could see that in the long term. Just I think the timing of it is something that investors and locals and everyone else needs to be a bit cautious of.
Okay, all right. Now, we know the economy has been battling a number of issues, COVID, rising debt and high inflation and so on, which has negatively impacted the property sector. So in your opinion, what does a thriving economy mean for property, and how important is it to have that thriving economy for property to grow?
Yeah, I think firstly, if COVID was an isolated case to Zambia, it would have been extremely detrimental. The reality is that it has hit the entire globe. So just from a demand perspective, demand has been extremely muted. And depending on the asset class you're looking at, particularly in Lusaka, for example, where retail was somewhat already oversupplied pre-COVID, once you start instituting lockdowns, the demand for retail is even more challenged. But now that there is possibly more circulation of capital in the market, and if government does indeed continue spending the way that they have proposed to in the budgets, it will lead to a lot more job creation. It will lead to a lot more supply of capital in the markets, meaning that there's a lot more disposable income, and customers would then be flocking back to your retail centers, to your markets, and even to your office spaces. So if there is sufficient capital circulating in the market, I think it creates a great environment to have a thriving real estate sector, and not only from a retail perspective, but from a residential perspective as well. As wealth is created, we may start seeing the migration from renters to owners, or migrating, to bigger units or to more affluent units. So there is definitely an opportunity for a thriving property market. And so far, the budget seems to have positioned itself to create this environment that will allow for a thriving real estate environment.
Okay. Mumba, you manage quite a number of portfolios. How has been what type of challenges have you faced with the COVID and
I think it's pretty similar as most landlords or investors. We do have some retail assets, and those were quite hit in terms of they actually lost a lot of our old leases were in dollars, and as a result, tenants not able to service those rentals. And then when COVID hit, the restaurants had to shut down. The bars and the betting companies as well had a time when I think there was a bit of a challenge. So I think it has affected certain sectors a lot more, mostly the restaurant business, where there's limited sitting was allowed. And so most of the properties you would expect a reduction in rental income. Collection rates were worse than what we had seen in the prior years. And as a result, occupancies were down, vacancies were up. We've seen a bit of a recovery this year, but we're not yet back to where we were pre-COVID and also pre-currency, the time before the currency was a bit more volatile. So it's been tough managing retail. Other assets or other asset classes like residential were a bit more stable, unless you did have some tenants that were maybe aligned with embassies or other type of institutions where they had to relocate or go back to their country. I think you might have seen a bit of pressure there, but I think it was quite wide ranging. Even schools were affected, and so it was quite wide range impact.
Okay. We also see some measures for revamping the economic zones, such as the introduction of tax incentives for the M-phase and industrial parks. That is like 0% tax for a period of 10 years from first year of commencement of works in these zones. So how would this be beneficial to, say, the industrial or manufacturing sectors?
Yeah, so I think it's a fairly delicate act of balancing, which the economists and policy makers need to look at. Because on the one hand, you want to create activities that generate income through numerous streams, including through tax collection, to increase fiscal. On the other hand, you still want to be able to attract investors and to attract economic activity. Mm-hmm. So if I look at it from an occupier perspective, a lot of the large corporate occupiers would be quite keen to position themselves in multi-facility economic zones or into specific jurisdictions that do provide some form of advantage. So if the advantage is in a form of saving, then immediately it already becomes quite attractive. So in terms of attracting and also retaining some of the existing manufacturers and players in in the industrial arena, it is probably a mechanism which government is rightfully utilizing to ensure that there's some form of industrial activity that takes place. So yes, on the one hand, the government may be starved from immediate corporate tax, but on the other hand, these industries would be employing local workforce. They may be procuring materials, goods, and services from the local environment. And through that means of employment and job creation, there could be auxiliary tax collections by government. So it is certainly something that would be looked at as attractive from an occupier perspective.
If I could also add, I think one thing we also need to be cognizant of is the current fiscal position, the state of the debt in the country. And I say that because I think foreign investors want currency stability. One of the biggest drivers or drainers of foreign exchange so far in the last few years has been the large debt burden that the country has. So I think from the minister's update is the engagement with the IMF. I think if that is done positively and it does give positive gains to the economy, I think that will also see foreign investors come back in, because at least it does support the currency as well. A lot of these investors, because they're multinationals, would also want to make sure that the investments are in a place where there's a stable macroeconomic environment. And so I think in as much as all these changes are being done and are supportive, I think it's important to see how the government handles the debt position. They have increased visibility of the debt, which is a positive. They are going the IMF route. If that is successful and brings in foreign exchange, brings in currency stability, brings in foreign direct investment, I think these policies of the MFES could be supported. But I think it's important to deal with the fiscal position. Otherwise, a lot of these policies might not bring the investors, again, as fast as we would prefer, if the macroeconomic environment is not stable, especially on the debt perspective.
Seems like we may have lost Gloria.
Gloria, are you still with us?
Yes, I'm still here. Yes, I am. Hello?
Yeah, we can hear you.
Yeah,
okay,
we can
I'm
hear
still
you.
Here. Okay, all right. Okay. The government intends to transform the agriculture sector as well and make it a more viable commercial undertaking. So to this end, we see the introduction of the zero rating for VAT purposes of selected agricultural equipment, and the intention to secure both technical and financial support for the development of some farming blocks, which are steps in the right direction in boosting the agriculture sector. So what opportunities can be harnessed from the agriculture sector in terms of agricultural property investments?
Yeah, so it is certainly a step in the right direction with regards to boosting the agricultural sector. If you look at food security as a whole, it is becoming a global concern, and Zambia is blessed with arable land and very fertile soil, with healthy rainfall as well, before even looking at mechanized water irrigation solutions. There's sufficient rainfall, and I think it's about taking advantage of the natural resources that are available within the country. The government is coming up with now is ready to augment the amount of activities that are taking place from an agricultural perspective. And it also then makes Zambia a lot more competitive, in the sense that not only are you farming for yourselves, but now you're able to also export and generate, foreign cash flows as well. And of course, that's again creating that healthy balance between having sufficient stock for local consumption, and then also having sufficient stock to export without starving the local populace. So from our side, it does look like it's a step in the right direction to just create some form of catalyst in the agricultural sector.
Mhm.
Yeah, I think the agri sector is one that needs to be exploited and really grown further, I think, as part of the ever continuing drive for diversification. I think it'll be interesting to see if there'll be some type of consolidation in the market. Right now, I think when you think of big agri businesses in Zambia, you think of the Zambeef as one of the large entities, and if you then break it down to property, they have outlets where they do, although they do predominantly own their properties. I mean, if you do have big players or big companies coming onto the scene for the property market, it could be potential space for retail. Of course, if you have a bigger, larger workforce, you need more accommodation, housing, and all those property sectors that flow in that ecosystem. Even warehousing, if there's need for large storage of grain and produce. And so anything that boosts the agri sector, I think is a help. I think for me, it would be interesting to see if there'll be some type of consolidation of businesses, to see if you can create much larger scale businesses, because I mean, the whole idea of larger businesses is the benefits of economies of scale. If we do have a second or third type Zambeef-like company that can compete and also be strong on the export market, I think that would be another boost, in my opinion, for the agri sector. As opposed to, yes, I think it is healthy to have small scale farmers who then also feed into these outgrower programs. But I think if you really want to have large scale businesses that export and compete at an international level, I think it would be helpful to have maybe one or two more larger firms that can also compete with the Zambeefs as well as with larger players internationally.
Okay. With the ever escalating construction costs, would you say the reduction of 0% of corporate income tax on manufacturing of ceramic products, such as ceramic tiles, perhaps help to bring costs down?
Yeah, I think that is a fairly instrumental contributor to escalations as well, and to your overall development costs. So from a developer's perspective, if you're able to develop the same stock that you were doing previously at a reduced rate, it improves your profit, and some of that profit could also be passed on to the end users, whether it's from a rental or from a sales perspective. So by adjusting those levies and the taxation levels, I think it could stimulate developers to build a bit more, considering that their build price could be reduced. And if I'm not mistaken, there's also a big drive for the production of ceramic products locally in Zambia. That could also allow for price differentiation, where the locally produced ceramic products are then sourced to go into developments, which also then leads to greater job and employment creations locally, which again is a benefit for the real estate industry. Yeah, Mumba, you want to add something on that one regarding the ceramic?
Yeah, I think you've spoken it well. Anything that reduces costs makes it construction builds cheaper. also allows for better profitability and further reinvestment in the sector. So yes, I agree on that point.
Then we also see a huge increase in the allocation of the Constituency Development Funds, CDF. That's from 1.6 million kwacha to 25.7 million kwacha. What impact would this possibly have on the real estate sector?
I mean, firstly, I guess it's the main question would then be how the funds will be spent. Of course, if now it's a lot more decentralized and decision making is now more at a constituency level, what type of projects would they be looking into? Would they be roads? Will it be refurbishing schools? Will it be refurbishing housing for employees and members of staff? I think really what you could expect mainly is anything that, again, creates employment, then creates that whole ecosystem of real estate, starting with residential, if there's places for people to sleep and stay. So you could see, especially if there's a rising demand and limited supply in areas, there'll be high demand, and that might increase rentals in areas. If you start seeing a lot more people building properties in those areas where there's increased expenditure, increased construction, and then you might just see an expansion of the properties. And like Mr. Patrick said earlier, you could see a shift in terms of the types of housing that people do stay in if there's that increase in wealth of people at the constituency level, where maybe you're moving from 1-bedroom house to 2-bedroom housing, and that changes in dynamics could then maybe be seen in the residential sector first. Other sectors like retail could maybe be on further down the line, but I think the immediate shock could be seen on the residential side, where those increased economic activities are taking place.
Yeah, it is indeed a very significant increase, especially compared to the other sector allocations. So I think if used well, we will probably see the residential sectors shift first from a localization perspective, and maybe through alternative income stream creations that may then trickle into the commercial space.
All right, and then we also see the finance minister has decided to maintain the 15% corporate income tax for hotels and lodges. We know this sector has been, the hospitality sector has been like really affected with the COVID-19 pandemic. And so this sort of aims to give relief to the hotels and the lodges. What do you think of this measure?
Again, anything that makes it more price competitive, makes you more better to compete internationally, especially for the hotels and lodges. I think domestic tourism is still a sector that's not yet been explored. I've seen some commentaries out there asking for different scales of pricing for domestic versus international, because I think there's still that gap that needs to be resolved in terms of our Zambians actually supporting their own domestic tourism sites. How many of us have gone to all parts of the country to see what the country has? So I think that's an important part of it. Internationally, again, Zambia could be constrained by the COVID pandemic. The government could do all these things. And if the COVID pandemic comes back and rears its head, all of these will count for nothing, because the country will probably be in some type of blacklist, and as we had seen in the past. And so I think in my opinion, focus should be on improving domestic tourism a lot more. International tourism will come, but if we don't sort out the domestic tourism gap, I think international tourism could be constrained by external forces.
Yeah, just to agree on what Mumba highlighted, domestic tourism is quite underrated, especially when you consider that a lot of the locals do go to regional countries as well as holiday destinations. And Zambia is already blessed with phenomenal tourist attractions. And the international or the global travel frequencies are not at the same level where they were 2-3 years ago. It is going to take time for the international community to gain confidence again with regards to traveling outside their own jurisdictions. But in the interim, you already have the infrastructure from a hospitality and tourism perspective. And that's where the opportunity lies, I believe, for creating products and attractions as well that speak to the local communities.
Mm-hmm. Okay. We also see the introduction of turnover tax of 4% on rental income below 800,000 kwacha. What are the pros and cons of this measure?
Yeah, look, on the one hand, the pro is that there's a bit more money going towards the fiscus. On the other hand, who will carry that increase, right? Would it be the landlords, or will the landlords pass it on to the tenants? You're talking about a price bracket where the tenants there are very price inelastic. So any mild change in price may actually force them to look elsewhere. So the landlords who are able to absorb that cost should probably do so in the interest of retaining tenants. Because the last thing you want to do now is increase cost, lose tenants, and there isn't an influx of incoming tenants as yet. If the budget goes according to plan, yeah, I think in the mid to long term, there'll be a lot more job creation, a lot more disposable income, and then we'll see the influx of tenants. But at this point in time, it's either if a landlord is unable to absorb it, maybe they could look at a 50-50 where they pass 2% to the tenant and they take on the 2%. If they're able to absorb the full 4%, even better, because then you have longevity of occupancy.
Mumba?
Yeah, this one has been quite an interesting topic, even discussing with other players in the property market. I think for the small scale investor, the family owner, the one who's trying to make a bit of money from properties, I think it's a positive. I mean, typically tax compliance in Zambia is, especially in the property market, is quite low. I mean, for all the attendants that are here, 26, I'd be interesting to do a poll to see how many actually withhold 10% of their rentals and pay to ZRA. But I think with the policy of pushing it to 4%, it could hopefully encourage more compliance. The burden of now paying the tax is now on the landlord. But like Mr. Patrick has said, who will then take up this additional burden? Will the landlord pass on the additional, or technically it should have always been there, but will they pass on that 4% to the tenant? And for those landlords who have rental incomes above 800,000, where you're talking now 30% again, will they pass that on to the tenants in terms of cost? The obligation is no longer on the tenant, but on the landlord, but a bill still has to be paid. And so, even speaking to your earlier question on inflation, on government managing inflation, if there's a widespread increase in rentals, that then results in an increase in also products, as if for commercial entities will pass that cost on to the customers. So I think it's a balancing one. I think it's one we need to wait and see a lot more from the ZRA. ZRA normally comes up with tax notes towards the end of the year, beginning of the year, just to see how this will be implemented and what will be the exact implications of it. But as it stands now, my interpretation initially is that it's good for the small scale investor looking to build up a property portfolio. For the larger scale investors and landlords with large property portfolios, it could be something that increases the tax bill and makes it a lot more, makes it very interesting how they'll engage their tenants, if they'll absorb that additional cost or they'll pass it on. I think it will be an interesting watch going into next year. And yes, and we think it's good. We should all look out for those tax notes from ZRA as they do come out.
Then in terms of student accommodation, student housing, I think this this sort of sector hasn't really been tapped into so much in terms of investment in this student housing accommodation. We see the student population keeps increasing every year. So what type of maybe packaging would you, in your opinion, would work for anyone wanting to invest in that?
Yeah, so with student accommodation is quite an interesting one, whereby your offtake would either come from the educational institution, or the offtake would be from the students or their parents directly. Traditionally, even from a South African perspective, a lot of the big funds preferred entering into transactions where the end user was the education institution. The last 18 months or so, there's been fairly sizable investments by REITs and by private family wealth as well into the student accommodation sector, where these investors are now actually fairly open to take some student risk or some student parent risk. And we see that pattern across numerous African cities as well, because the educational institutions are also limiting their exposure when it comes to underwriting liabilities for the students. So more and more investors actually have to take exposure directly to the students. So I think if investors look at it from a phase perspective, where they test the market with a specific product that is maybe fully furnished with internet and backup water and electricity, so the general auxiliary services that students require. And as they gain momentum and reputation, they can then continue adding on various phases. From my last visit in Zambia, which was actually just before COVID, it was very evident that this is a field that is yet to be fully serviced. So there's still a good opportunity to provide affordable and quality products for the student population.
I do agree with the thoughts and sentiments of Patrick. Even looking at the Lusaka student population, or maybe before I bring my point, I think we also have to be cautious and aware of the same thing. The COVID pandemic has also shifted a lot of the way people do school and the way people do university. The trends pre-COVID, where I think this sector was really going to be one that was going to elevate and improve. I think of student accommodation like how retail used to be a long time before the large scale malls came in, where you had more community-based small retail shops. Student accommodation is that currently, where you have a lot more small private owned homes. And you don't have a lot of large scale student accommodations like we see in places like South Africa. But now that COVID has come and seems to have gone, and students are now back at school. I think that's a discussion that needs to take place. I don't know if the scale and size would fit what were the expectations pre-COVID, because I think we also have to be cautious to the fact that a lot of the world is now virtual, and even schools will probably be shifting in how they give their products if online becomes a lot more prevalent. But I think there'll always still be scope for physical learning. I think the University of Zambia has a large student population. A lot of the private universities have a large student population, and you don't have that mass or scale student accommodation products that you have seen. And so I think Patrick's points are important. I think in Zambia, of taking from the universities would be interesting to see if that can be achieved. I think most likely taking the parent risk will be the first step. And then, yeah, I think it's something that we also looking out for within our portfolios to try and have a more formal student accommodation portfolio.
Yeah, and maybe just to add on to that and looking at global trends. Often, again, an investor wants to go into a greenfield development, right, where they build from the ground up. Look at Cairo Road, for example, and the amount of corporates who have decentralized or migrated from Cairo Road, where you've got newer and more established office parks coming up. You're left with infrastructure that is still strong, from a bones and from a construction perspective. And a lot of that infrastructure can actually be repurposed for student accommodation, considering that you have a lot of education facilities within comfortable reach to Cairo Road. And you've got amenities which are usually frequented by students. So there is an opportunity as well to refurbish some of the existing, call it semi-obsolete office stock that is still well built. Some of those buildings can be repositioned for student accommodation.
Patrick, okay. maybe just a question. Sorry if I'm being a moderator now. What's been your experience in Joburg or in other towns in South Africa? Have you seen that trend? I know Joburg CBD also has similar trends. Maybe not so much to Cairo Road, but what has been the trends in a place like South Africa when it comes to student accommodation in those type of areas?
So obviously the closer you are to the financial, or the closer you are to the educational institution, the better. If you are within comfortable walking distance and you are within a bus route, for example, sometimes the actual building can even get accredited by the university. And if the building is accredited by the university, it's a lot more attractive. And it's also easier to place students who are on bursary. So there's the entire ecosystem that you are leveraging off if you get accreditation. And to get accreditation, there are minimum requirements that you need to meet prescribed by the university. However, there are some developers who had stock and who realized that there was an opportunity, and they went and refurbished their properties without necessarily going through the accreditation route. But because they are in close proximity, either to the education facility or to a transport route that goes to the education facilities, their occupancies are 95 to 100%, if not. And in places like Joburg, Durban, Cape Town, it's quite common that your December and January periods are empty because the students are back at home, right? But during the rest of the year, you've got your guaranteed 10 or 10 and a half months income. Unless it's a student who's on a bursary that comes in first year, you then have the benefit of having 3 years cash flow coming in from a corporate. Even if you look at places like Botswana, in Gaborone in particular, and even in Lilongwe, in Malawi, we're starting to it now, either because of parking challenges or because demand has moved elsewhere. Those office blocks are being repositioned for student accommodation. So as long as amenities, little and either solar or generator backup, then you've got an asset that should be attractive.
Thank you, Patrick. Mumba, ask questions. Now is the time to do our dollar leases of commercial properties, looking at what we've been through with the past year or so.
Yeah, very, very popular question indeed. Yeah. Yes and no. I think for dollar earning tenants and dollar earning institutions, multinationals that actually earn in dollars, is no reason is quite stable for the longest term. I know most dollar leases you'll find are CPI +3 or CPI +1, and that's returns to range 3 to even 4%. So the dollar is a generally stable currency, and in the long term, because typical constructions you do require some importing from outside, there's always going to be some form of dollarization in your construction build. The need for dollars leases is still there, but mainly should be focused towards those the other embassies. I think those dollar leases. In the sector, the anchors are, and the anchor for retail is in Kwacha, which is Kwacharized. They take up. I do know some who try, especially for the small ones, they also dollar leases locked in the long term. The currency low, the Kwacha lease much here to be something that we done on it. The much tenants, it's more, your cash flow more predictable compared to leasing the rates.
All right. Then we
I think from the tax laws and the tax notes from ZRA, from what you read, it appears now there's going to be turnover tax at 4% for rentals below 800,000. Rentals above 800,000 per annum will be at the corporate income tax level. So it's not clear if the 10% will be abolished, but to answer the question, 10% in the old regime pre-budget was fantastic. Now going, I think some interpretations say that still be withholding those credits to knock off the corporate income tax when they do file these. I think let's see from the tax notes after what's the guidance on that, if that 10% is abolished. But to answer the question, yes, it was final tax pre-budget.
okay, sure. Just in conclusion, going forward, which sectors should potential real estate investors be looking out for?
Yeah, that's an interesting one, especially considering that churches or other places of religious worship, educational facilities have been starved from visitation the last 15, 18 months, right? We're starting to see a mild demand coming back in those sectors. So the alternative industries, right? I think it also goes without saying that from an industrial perspective, data centers, distribution centers, logistic parks, again, that are well priced. I think those are sectors to look out for. The lowest hanging fruit, if you look at Lusaka CBD, in my personal opinion, is probably student accommodation, because you already have the population, you already have the quite a lot of money from a transportation perspective. And then in the smaller town, it's very basic retail, not the town. I think basic retail, there's probably still a bit of there.
Okay, number?
Yeah. Echo. Good. Same single store or where you want shops in that data center as comes digital. Local where you pay to that.
Thank you.
Okay.
Gloria, thank you.
Joined us. Enjoyed the discussion. Remember, always before deciding the state. It's good to enjoy the rest of the day.